Hey everybody, my name is Kyle Knott, and I am not your average finance guy. Got the whiteboard up, so I figured I might as well put the website up there. So today, what I want to talk to you about, I've talked to a couple people that have like safe harbor money. So they've got this money, it makes them feel good. Maybe it's in a savings account or CDs or bonds, or it's not going to lose money. They feel warm and cozy, and if you really think about it, the returns that they're making on that money, if it's in a savings account or even bonds or anything right now, you need a microscope to see them because they're so small. So why not get that safe money out of there and put it into another vehicle, and which is in my mind safer, and also will guarantee to pay you between 2 and 3%. That's guaranteed. Plus, there are also dividends, which will probably bump that up by at least 1% or 2%. So, but where I'm getting on my policy right now is I'm about 6.6% is what the entire payout was. So if you've got safe money and you kind of want to hold it there, say you've got it in a CD. That CD then is locked up for X amount of months, right? Maybe it's a 12-month CD, maybe it's a 5-year CD. But you cannot touch that money, but you know it's there if you ever need it, and you know it's guaranteed, you think it's guaranteed, and it's going to grow by a little bit, right? So if you put this into an infinite banking policy, this to me is safer money than all of that stuff. Okay, it's got predictable growth. You know it's guaranteed to grow by depending on which company the policy's with, and there's a bunch of different things that go into it, but most of them, I've never seen one smaller than 2%. Most of them are guaranteed right around 3%. So you could take that 3% and you can guarantee that. Plus, if they pay the dividends, which all of the companies that we work with have paid dividends 100% of the time for over 100 years. Most of them almost since like the Civil War. I'm with Mass Mutual, and they just had an article came out that they paid consistently every single year for 157 years, I think it was. So this stuff, even though you can't say it's guaranteed, it's probably going to happen. Okay. All of the growth in there, if you have that inside a CD, your CD grows, and when you make the money off that, whatever it does grow to because of the interest rate, that is taxable. That is income. If you put this into an infinite banking policy, that cash value grows and grows at the guaranteed, 3% or up to whatever 6, 7%, whatever it could be. That grows, and that grows tax deferred, tax free. Okay. If and when you want to take money out of that IBC infinite banking policy, it's considered a loan. Okay. So with it being considered a loan, you don't really have to ever pay back if you don't want to. So you pull that out. Loans are non-taxable events. So that is not, you don't pay tax on it. Okay. You put the money in there, it grows. You don't pay money on the growth. And if and when you want to take some out, maybe it's later in your life for retirement or whatever, there's tons of policies I've seen where people take well over $100,000 a year out, and their cash value is still growing and growing. A lot of times I've seen them that they're growing by 300,000 even though they take 100,000 out. So these things just, if done properly, can continue to go and go. You got flexibility and control. There's no, like I said with the CD, there's no time limit. If it's 5 years before I can touch my money, if you've got cash value in there and you need it for something, you can take it for whatever you want. There's no required minimum distributions. So after you hit a certain age, if you want to leave it in there and let it soak, and you've got other stuff that you're relying on, go ahead. If you need money for whatever you want to buy a new car, you want your give some money to your grandkids' college fund. It really does not matter what you want the money for. And they have to give it you. There's no applications, there's no fees, sometimes there's an application just because they need to know where to send the money, but it's no questions asked. You don't have to go down to the bank and tell them that ask you to take out a loan. They don't need your firstborn's blood type and got to see all of your 401k records and all your statements, and they have to be current. And then, no, this doesn't work, I need that. It takes forever, right? So none of that stuff's happening, and it's guaranteed. Like I said, it's guaranteed to grow larger every year by the minimum of 3-ish%, but it's always been more than that for over 100 years, almost since the Civil War. So to me, this is a way better place to put your safe money. People think their money is safe in the banks under FDIC insurance, but if you Google FDIC and really get into the weeds about that FDIC insurance, you'll see that the federal government has this much money set aside to pay out on the FDIC insured, where there's like this much money in the actual system. So if the system crashes, all this is gone, and they have this much money to pay out. So it's not gonna, if it ever happens, we got bigger problems anyway. So if you put this over in the IBC policy, they've got way more reserves, and they're contractually obligated to pay you that guaranteed money, and it's way safer over there because they've got more in reserves to pay out what they've got out there. So it's if you look at it that way, it's way better than the FDIC insurance program. So, all right, I hope this helps. Remember, hit me up on my website there if you got any questions. I'd be glad to help, and best of luck to everybody. Thank you.